In under 10 minutes time, you're going to know how to reduce tax, pay yourself efficiently, and keep HMRC at bay using your director's loan account. And I promise you, it's not going to be as complicated as most accountants make it. A director's loan is like a bank account between you and your company that exists on your accounting software. If you take money out of this bank account that isn't treated as a salary, dividend, or business expense, it gets recorded in your director's loan accounts. If you put money into the company, so you're investing capital, maybe to fund growth or repay back one of these loans, it also gets recorded in your director's loan account. This accumulates a balance with the money in and the money out, and that determines whether you owe the company money or the company owes you money. So now you know what it is. How do we actually utilize it to save tax? The first way is you can borrow up to £10,000 from your company without triggering income tax or national insurance. Above £10,000, it does trigger that unless you charge HMRC's official rate of interest. What is the purpose of this? It means that you can have a short-term cash flow requirement satisfied personally without having to declare a salary or a dividend, which can save tax. A practical example of this may be a wedding. It may be that you've got to pay a loan to a family member, and it allows you to leverage it without pushing yourself up into that higher rate tax band. It's worth noting that you need to repay this back or clear it down at a later date with a dividend or a salary. There's two positions that your director's loan account can be in. One of them is you owing to the company, another is the company owing you. And this is what's called a debit position or a credit position. A debit position being an asset to the business, meaning that you owe the company money, and a credit position being a liability to the business, meaning that the company owes you money. Both of these have different treatments, different considerations, and different ways we can leverage. Let's get into it. So first, we're going to discuss a debit position. So this is an asset that's sat on your balance sheet because you owe the company money. There's a multitude of different factors that this could be the case. One is you may have taken a short-term loan to satisfy a personal cash flow requirement. The next is you may have taken money out of the business that your accountant's not yet declared as a dividend. It may be that you have overtaken money out of the company past the point where you have retained earnings, which essentially means that you no longer have distributable income sat on your balance sheet, so you can't legally declare a dividend. Another would be that you use your company card for personal transactions, meaning it's not allowed to be tax deductible and therefore gets moved to your director's loan account. Now, there's no legal limit on how high your debit position can get. However, they all have tax considerations, and it could end up costing you a lot of money as well as cash flow issues. The first consideration being that if it goes above £10,000, you can trigger what's called a benefit in kind, which HMRC deem a benefit to you because you've taken the loan free of income tax and national insurance. Now, that would mean you would have to pay personal tax on that benefit via your personal tax return, something you want to avoid. However, you can charge HMRC's official rate of interest, which means that because interest is being charged on that loan, it's not a benefit to you, so you no longer have to report it on your P11D, which is tax payable by your personal tax return. The next consideration, which is another level up, is if your director's loan account is in a debit position, so you owe back to the company at your financial year end and it isn't repaid within 9 months and 1 day, it triggers what's called S455 tax, which is a temporary tax that HMRC will charge you on your corporation tax return of 33.75%, which essentially is HMRC saying you should have taken this as a dividend, so we're going to charge you a temporary tax on that until you actually do take it as a dividend or pay it back to the company. This can cause massive issues for cash flow, and you really want to avoid it with careful planning. Now, I want to give you a few pieces of advice here. When you do pay for an expense on the company card that potentially isn't wholly and exclusively for the purpose of the trade, if your accountant deems that to be disallowed, they are going to push it to your director's loan account. So please be careful what you're spending on that card, and make sure you've got that open dialogue with what is and isn't an allowable expense. If you do get in a position where you've got to report a benefit in kind by your P11D, which means that you haven't charged interest and your director's loan account is above £10,000, you're then going to have to pay 15% Class 1A national insurance via the business and also personal tax at the applicable rate on your personal tax return. So you really want to avoid this. Now, ways to actually reduce this debit balance is one, the money that you've got sat on that balance, you reduce via taking a salary, or you vote a dividend, or you pay the money back. They're the main ways that you can reduce this, but accurately planning in advance can avoid any of these situations happening in the first place. and of course, get the right advisor. Now, the next slightly better position to be in, it's in a credit position. It's a liability to the company, meaning that the company owes you the money. Now, situations where this would happen, you've pumped money into the business to fund growth. You've lent the company some money to pay a HMRC bill or to pay a supplier. So at this point in time, the company has had surplus funds than you have actually taken out, which means you're in a position where you can take that back tax-free, should you wish and should the company be able to afford it. The company isn't required to pay any taxes on the amount that you owe because it's a loan. It's not treated as income. You're not going to have to pay corporation tax. And when you do take it back out, as I've mentioned, it's tax-free. One way you can leverage this balance to benefit you from a personal tax standpoint and save tax for the company is by charging a commercial rate of interest on the loan, which essentially means if you was to go out to market and get unsecured lending, what interest rate would you pay? You can then apply a similar interest rate to the amount that the company owes back to you, claim corporation tax relief, and also take that money out back tax-free as and when the company can pay it. It's worth noting that you need to complete what's called a CT61 form, deduct 20% income tax, and then complete the relevant submissions for compliance. But this is a great way to leverage additional savings on a credit balance. One thing I really want to stress, because this is a really useful tool when used correctly, is timing your dividends in the right tax years, as well as ensuring that they're split by a spouse or any available opportunities to reduce overall tax. You can leverage your director's loan to help you do this. Another example to benefit you personally and in the company is reimbursing yourself tax-free. Let's say you use your personal card for legitimate business expenses. The company owes you that money back. Let's use another example. You've got a personal car that you are taking on business trips. You can claim wear and tear of your personal vehicle at 45 pence a mile for the first 10,000, 25 pence thereafter, meaning that you can reimburse yourself whatever the value is of them transactions tax-free. And the last point I want to leave you with here is bed and breakfasting. You might be wondering what the hell I'm talking about, but if you repay back your director's loan and take the same money back out within 30 days to try and avoid the S455 or the benefit in kind, that is anti-avoidance. You can't do it. HMRC will not allow it. So don't get caught, and make sure you leverage all of these strategies that I've told you in the video to save as much tax as possible, pay yourself efficiently, and keep HMRC at bay.